Hello, folks, and welcome again to another Financial Fitness with Patrick, presented by Soaring Prophets Media. And as well, folks, what a week. What a week it's been. Yesterday, we had Jerome Powell come out with the FOMC. Jerome Powell, chair of the FOMC, comes out, does a great presentation, and the market goes crazy. How does it go crazy? It goes crazy up. Who would have thought? We have this wild problem that we have going on right now where we're seeing inflation reinflating within the economy. And Jerome, a guy that was data dependent, he thought that he would just wait and see. We're gonna feel what the economy is doing from the inside. Now he's not so data dependent, and he's making these risk on asset classes really pop. And he's basically given the green light for this bubble to continue moving. And you know, there's a lot of people out there that disagree with me in the comments in regards to whether we're in an asset class bubble. Is this an everything bubble? What is this going to look like over the next 5 and 10 years? But when we see what we saw out of the Federal Reserve chair yesterday, Jerome, he seems to not be in the same realm that he has been for the last 8 to 12 months. Everything we've seen out of their office was, we're looking at the data, we're assessing it daily, we're making decisions based on the information that we're garnering. Employment is maintaining from what they're saying. However, we've had revision after revision after revision after revision downward. We're seeing inflation. If we're looking at our yield curves, right? One of the big indicators of recession is a yield curve inversion. And that's where we have long-term yields, you know, our 5, 7, 10-year, 20-year bond yields. They need to be higher, right? If I'm giving you my money, they need to be higher in expectation and return on my money than something very short term. And we're inverted. Our short-term bond yields are, you know, around that 4.5% range. Well, our 4.3 for a 10-year doesn't work. And when we're that inverted, traditionally, historically, that has been a telltale sign of recession is imminent. And somehow we keep talking about the soft landing. And the market has rallied off of that November kind of low, that pullback off of the run up from 22 into 23. And now we've got this weird asset risk on class that's really pushing forward. We're seeing very, very specific stocks that are interest rate sensitive. We've seen Elon Musk talk about this months ago when he talked about Tesla and the interest rates that are going to be crushing somewhat of their clientele in regards to purchasing products. An $80,000 Tesla at 5% is a very different monthly payment than it is at 8 or 9%, right? That makes sense to everybody. But we're seeing it in our lending. Some of these like Affirm type products where, you know, these buy now, pay later stocks have had these really great years on the expectation that the Fed will be pivoting. Well, the Fed isn't pivoting. The Fed hasn't pivoted. They were supposed to pivot in March. That was the saving grace in November. We've hit our capital rate. We are going to start looking at pausing, and then our next expected move is a pullback and dropping rates. No one is expecting that until maybe September at the earliest. Now, June really does look off the table from the hawkish perspective that we're seeing from other members of the Federal Reserve Bank. But Jerome comes out, he's wearing that purple tie like he just loves to rock, and he looks sharp doing it. However, he's coming out more dovish than what was otherwise programmed into the market already. So what we've seen over the last 2 days a really strong rally again in the risk on assets. And that risk on perspective, a really great indicator of that is Bitcoin. We've looked at Bitcoin over the last about month and a half. This is the astronomical view that it has. We've had about a 60% run up in Bitcoin in about 45 days. Now, Bitcoin, crypto, these asset classes, I've had a good friend of mine, she described them as wildfire, and I think that's a great way to do it. And I think that brings me perfectly into our guest today, Jennifer Burnham-Grubbs, the CEO. Let's bring her in here.
Hi.
She's the CEO of Quantum Insurance Services. And Jennifer, you pitched to me having a conversation in and around the crypto space, the Bitcoin space, and what's going on in that world. And you and your business, it's a little bit different. You're a little bit more risk averse. You're making sure that individuals are a little bit more safer in their perspective. Maybe tell me a little bit about you and what you do at Quantum Insurance Services before we kind of dive into some of the harder hitting questions about risk assets.
I love it. Well, hi, Patrick, and thanks for that update. I had actually been meaning to sort of look at that video of Palace, so now I don't have to, thanks
There
to
you
you.
go.
Yeah, it's not a big surprise, right? Well, so I should start by saying I'm the founder and CEO of Quantum Insurance Services. So we're independent risk management consultants. We work with clients all across the US. We work with a lot of the top brass of business managers, attorneys, accountants. We have a lot of high-end clientele, extreme high net worth or celebrity and athlete clientele, as well as sort of anything white collar and up. And we are masters of insurance. So we know, nerds about insurance are better than just like generalists about insurance. I can tell you that much. And what we like to do is position insurance in the context of a full portfolio because it has its place, just like many other financial tools have their place. And the trick is knowing exactly how to use them and what combination to use so that you actually succeed. That's what really smart money does. You'll see that a lot in private wealth. And we do a lot of advising in that space.
Well, so you sort of, self-quoted as a math nerd, but a people person, right? I believe that's
Yes,
a really
that's
good way to
so
describe
true.
you. I think that's a really
Yes.
fantastic way of doing that. But so you started this after your time in boutique insurance. So you started Quantum and went from there. But Bitcoin, like this is what everyone is talking about right now. Like talk about a hot button topic. And there are people that are absolutely for it. They think it is the next coming. And then there's people that are like, burn it down. This is all a scam. It is a pyramid. It is all going to go to hell. What is your kind of overarching view of crypto?
Oh, I mean, I think it's the end of the financial world as we know it in certain ways, no matter what. I did say it's wildfire, and I think it's exciting wildfire. I think all of blockchain is exciting. Um, I think it's a lot like playing with fire. You need to have really good guardrails and lots of really good training and information to be able to use it cleverly, successfully, and without ending up with char on your carpet or your face or, or burning your whole house down. And I know you and I kind of are, I'm personally invested in Bitcoin, but not until I had all my diversification and risk management in place. And that's something that, we can definitely talk about. Where and how does it have a place? And why are more and more financial institutions coming off the ledge of this is the most dangerous thing on the planet, because it is, to, well, maybe we need to sort of participate with it, but they're certainly not going to go off the deep end of it. And Warren Buffett, as we all know, is really very conservative. We can talk about why as well with that.
Absolutely. Well, James, why don't you pull up the chart for us there? Let's take a look at what Bitcoin looks like as of today. So what we're looking at here, folks, for the profiteers out there that follow the technical analysis side of financial fitness, this is the Bitcoin chart over the last, what are we looking at? Almost 4 years, 3.5, 4 years, right? So down here, these spikes are volatility spikes. So as we see big peaks and valleys, that's volatility coming into the market. That's the amount of sale that's coming in, the amount of Bitcoins purchased, bought, and sold, right? So this looks great if you buy it here, right? And this is the perspective of Bitcoin, is that if you had bought it in 2008 with Satoshi Nakamoto and bought that first pizza for 10,000 Bitcoin that is now, well, we can do the math on it. Let's call it a $30 million pizza. That was the first transaction in Bitcoin. Then you've done fantastic in Bitcoin. The problem arises when you start buying it in and around here, and you can't sleep at night, right? When these big spikes and valleys. And Jennifer, just before we jump into some other things, looking at technical analysis, and those out there that have kind of followed our technical analysis courses that we've done previously, what we've seen here, this is a double top, right? A double top resistance. It's tested, it's broken through slightly, but has struggled, and that's why we've seen this major pullback. We use technical analysis as a bit of an indicator of sentiment in the market, right? Not everything goes straight up, not everything goes straight down. There's fluctuations in that volatility, right? That volatility is huge. And in Bitcoin, lots of people are day trading it. So they're playing both sides of it. They're going long, they're going short, they're taking money on the ride up, they're taking money on the ride down. That makes it a very volatile asset class. And Jennifer, I think that kind of brings me to your question. My question to you is, how do you look at a chart like that and say, I'm willing to throw the mortgage. I'm going to refinance my property. James, you can pull that down, pal. I'm going to refinance my properties, and I'm going all in on this bear run of 65, 70%. What do you say to people like that?
Please don't. Please don't. Please don't. It's insane. Do not do that.
I love it.
Don't do that. That's terrifying. Just even hearing you talk about the short-term trades, I was starting to hyperventilate a little bit.
Right.
I'm a big believer that the only way to play safely with wildfire, which I consider to be any high risk, high reward product, and there are many, but Bitcoin being the asymptote of risk, there is nothing riskier than crypto at this point. I don't know, except for maybe giving your baby brother $100,000 and telling him to go start like a company or something. Right. No offense to my baby brother, but other than that, from established financial products, right, I would consider crypto to be one of the absolute most risky. It's a little bit untested. It is complex. There's a lot of fraud. There's just so we could go on and on.
Right.
You can't go do anything like that until you have your risks over the big picture secured. So this is what insurance companies do. Okay, this is what smart risk management does. You always secure the worst case scenario first. Always, 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 always. You make sure that whatever happens, you don't lose the home. Whatever happens, there's a roof over the head. Whatever happens, there's some way to continue having some kind of income coming in, passive income or employment or whatever that is. Once you've taken care of all the worst case scenario, you go live your best life and you dabble in high risk, high reward opportunities, because low risk, high reward, okay, is going to be steady, predictable, and get you very respectable gains, right? That's like owning a home for 30 years. You're probably going to come out ahead, right? It's going to take a long time. It might be quite lovely. It might have 200 or 300% on your principal, but it's not going to be the exciting, oh, I made 75% in 3 years somehow, with like crypto.
Yeah.
But you just cannot think of it as a balance or a pie. You cannot go binging on high risk, high reward without devastation occurring to you or your family. It's just the way it works. It's just the way it works.
No, absolutely. And, we talked slightly before we got into this about, what BlackRock has done. And, the CEO of BlackRock 6 months ago, 8 months ago, a year and a half ago was, I don't really believe in it. Right. We see JP Morgan CEO going, we're never going to offer these products. It's just not in our portfolio. We don't see it being in our portfolio. So you're a professional in finance. Why do you think all of a sudden we're seeing these ETFs pop up?
Because they're afraid of having people go all in on Bitcoin and losing part of the money. So they want to, instead of, you can't beat them, join them. Now they want to make sure that at least if there are going to be people going crazy and doing crazy things in a sector that's very high risk, that they can participate instead of losing all of those customers who will go off the deep end and then also end up probably most of them depleting their overall wealth. It's one of those things where they're participating for the sake of retaining and building a bridge into this sort of world of digital money, which is what's really happening. If you ask me, we're in a really beautiful and interesting transition, right? We're in an economy that's broken all the models. Everyone says this has never happened before. It's never come together in quite this way. So that's exciting and uncertain. And then we've got these new opportunities where people can be excited by or enticed by. And that's, by the way, why everybody's going into crypto right now, because the market's disappointing. And the market's also very weird and volatile. Interest rates are weird. So there's not a lot of liquidity except for the very rich who don't have any incentive to go risk it, right? Why should they go risk it? And everyone else who's looking to try and make some money is stuck in CDs or bonds, maybe, if they didn't get access to the kind of tools we know about, which are very helpful, very competitive, even with CDs in today's market, etc. That I could get off that soapbox.
Well, but that leads perfectly into this next question, because again, the last time we had you on, yields were crazy. You were getting 5.5 on bond yields. That Jennifer, if you had told me when I was a young man that bond yields would have been what I'd be talking about and it was sexy, I never would have, I would never would have believed you. Yet here we are. But we've seen yields fall, right? We're seeing them pull back. We're seeing them pop again with some of the inflation concerns that are coming out there again. But how is that affecting? Because that's volatility again in this bond market. How is that affecting the products that you're offering?
I think it's really unfortunate because a lot of people listen to whatever their uncle or somebody online said, and it's just there's an entire industry dedicated to managing conservative risk with steady rewards. That's what the insurance has done forever and ever. It offers tax to, I mean, the minute you buy a life insurance policy, you've got tax-free hundreds or thousands of dollars or millions of dollars going into your wealth transfer, into your legacy. The minute you buy the policy from day one, you've got something like 1,000x return, all tax-free. There's no tax diversification in most of the other financial tools that people like to play with. Even Bitcoin, even real estate, you're going to have some capital gains, right? So tax diversification with risk management is one thing. Bonds aren't tax diversified, but risk management products are. And then risk management products, because they're always using mortality and morbidity risk on the back end to do this math, they can offer 5% returns forever, not just for 3 years, not just for a season, but people don't understand. So what people are doing now is they think that they're going to bonds or CDs, which again isn't going to last. This interest rate sensitive market, and the fact that people thought interest rates would stop being sensitive, we just were in a weird honeymoon of 8, 11 years where interest rates stopped acting like interest rates. And everybody made the mistake of thinking, well, I can go into interest rate sensitive products and everything will be okay. That's really much almost never been really a good idea. No. Just like working with really volatile crypto is also, you're kind of fooling yourself if you think you can do all of that better than the house.
Right. Yeah. Well, and that's it. They are designed, and I think that's a great analogy, the house, right? They're designed to take their chips off the table first, and then the rest of the people end up holding the bag, right? And we've seen that time and time and time again. So that risk aversion that you folks from Quantum Insurance Services brings to the table, and you do it in a beautiful way because you make it easy, you make it accessible, and you're able to tailor these products to the individuals. We talked kind of a little bit about what you folks do in our previous episode. Make sure you check that out again. You can check all of our links. I'll throw it in the link as well when we throw this up next week. But with the products that are out there, with the market the way that it is right now, seeing, like I look at SoFi as these DeFi products. They built a beautiful stadium, but they almost went bankrupt this year. Like to me, that was supposed to be the next branch of this blockchain, decentralizing this financial institution. What is safe in this environment? When you're putting your clients into a product, what are some of the questions you're asking your people? You're obviously making sure that the rest of their nest is nice and safe, but what are some of the questions that you're asking your clients?
I look at where they're leveraged so far, right? So do they own a home? Yes or no? Are they putting any money away? Are they in a 401k? Is there matching at their company? If so, great. Are they contributing above the match or just what they get the free money with the match and then the rest they can go put into intelligent products? We look at what dependents they have, what risk they're exposed to, as a family. And then we talk about, okay, where are you putting savings if you have it? Obviously, there's people who are just hand to mouth right now trying to just, they don't own a home or anything. But once we tend to work with, like I said, white collar and up. So if we're talking about wealthy people who are just trying to get the best possible advice, the idea is you take a portion and you put it into a cash value life insurance product because then it all grows tax free, which the rest of your stuff isn't. It's like a super Roth, right? Roths are pretty cool. But even I won't say go put all of it into a cash value life insurance product. That's just a corner of the triangle. I like to say real estate is a big part of it. The stock market is a big part of it. And then risk management is a big part of it. When you do all of that, you're going to be and stay very wealthy. You're going to avoid a ton of taxes when you do legacy and wealth transfer. You're going to have a lot of guarantees. And then you're going to have upside potential in some of the more interest rate or fluctuating kind of financial sectors. And where does crypto come in with that? It comes down to, do you really need to even risk it? If you're pretty well set, you don't even need to really be taking on that risk. That's why Warren Buffett isn't doing it. He's
Right.
one of the wealthiest people in the world. He has no need for that. The people who are really dabbling right now are people who are looking for something fast, something that can give them better than 5%, because a lot of the rest of the financial sector is somewhat broken, other than, I hate to say it, but risk management, because risk management is doing great. They've never over leveraged. They have to have all these returns and reserves. So they're, unlike even the banks, they're the ones sitting quite a bit on cash.
Right.
So they're in the catbird seat right now, but all the other interest rate sensitive sectors are struggling, and so is the stock market to some extent because of the interest rate sensitivity. That was a very long answer, but that's the
No
point. You need
poignant. You hit all the topics there, and I think that you brought up the banking sector, and they even with the cash reserves that they have, there's been lots of speculation that as interest rates roll up, are they going to be able to continue to be profitable, right? Because they've got to be paying that out somewhere. We're seeing the deposits lower. So, we saw Silicon Valley Bank this time last year. We saw New York Community Futures the other day that's basically come out and needed a massive infusion of cash. When we see cornerstones, like these are not small little banks. These are good sized institutions that are saying we're cash strapped. We need to figure out what we're going to do next. The little guy, mom and pop investor, someone who's trying to manage their own portfolio, they need professional help. And again, going back to what you folks do at Quantum Insurance Services, I think that you're able to guide people. First of all, going back to your moniker, the math nerd as a people person, I think that works perfectly, right? You understand the products that you're selling, but you do it in this kind of really heart-centered approach that we're going to make sure that you're going to be okay. We're going to go through this together, and we're going to make it easy for you to understand. And that's why you're doing this chat here tonight, right? You're putting yourself out there to educate. And there's all too many people in the space that aren't. They just are looking to ascertain that client, get the deal signed, and then move forward, right? So one more question before you go. If you were redoing your portfolio, what are some things that you would be throwing in there today? What would that look like?
How much would I have to play with? You're saying what would I be selling and
Say
shifting and
100,000, and
trading,
then you can
or?
times it by X how much you got in your pockets.
Oh, wow. I would love, I think if I had extra that I thought was a good opportunity kind of thing, I would probably try to get some distressed real estate if I could. A piece
Commercial.
of a piece of that maybe. But it would be so important to be working with good operators, because like I have learned so much about operators when it comes to real
Yeah.
estate and real estate syndications. My gosh. I mean, I give you this answer letting everyone know in full disclosure, I have my cash value life insurance with my long-term care rider. It's growing beautifully. It's gotten me 6 or 7% and continues to do that. Sometimes even get 8 or 10%. And I get my minimum guarantees when the stock market has changed. So I'm sitting pretty with my risk management, right? I do have a little bit in Bitcoin, because I wanted to see if I could get some of those quick gains. I'm watching it fluctuate between $5,000 and $6,000 within an hour sometimes, and that's like, So I don't have a huge portion of my life invested in this. I'm again taking my own medicine. As I own a home, thank God. I feel very blessed, but I worked hard to get that first foothold in my real estate. I have participated in a real estate syndicate. To be frank, it's been a little disappointing because it was an interest rate sensitive investment. So it's
Okay.
been delayed, and that's
Yeah.
irritating.
Right.
But yeah, I mean, if I really were gonna, I'm very, very, very distrustful of the stock market right now. I just don't, I don't love that.
Well, it goes to exactly what my introduction was sort of about, is that Powell comes out this week and basically waves this green flag for risk on assets. He basically says, for the last year and a bit, that we're going to be data dependent. We're going to be data dependent. We're going to be data dependent. The data has not been good. The data has been inflationary. And then all of a sudden, he's no longer data dependent. So there's lots of people that are looking at the market trying to read the messaging, read between the lines, and we're like, what happened to data dependency? You just threw that right out the window, right? I couldn't agree with you more. The stock market, I think if you took a lot of the infrastructure budget that's been spent from the federal government, the stimulus with the student loan, forgiveness that's going on right now, our market as a whole would be very different. Doesn't matter where you fall politically on that. You can look at the numbers. There's a lot of money rolling out of the federal government right now to different programs, different incentives that we are stimulating massively economy, while the Federal Reserve that controls money flow, right? They're tightening. So one's pulling down, one's trying to prop up. It's a very weird dichotomy we have in the market right now. But again, that implies volatility. And in volatility, there's opportunity. You can run up, you can run down. And that's, you and what you're offering your clients. It sounds like you do a little bit, more risk in your personal life, as you should. Your clients' money is their money. It's their nest egg. You're making sure that it's safe. But as we're looking at these asset classes, it is so tricky to kind of read the tea leaves at the moment. And I'm just glad that there's amazing professionals like yourself and your team at Quantum Insurance Services that are there to hedge for a lot of individuals that otherwise might not have the overall expertise to get themselves out of it. But Jennifer, again, I want to thank you so much for coming on here. It's always a pleasure when we get to pick your brain on what's going on in the world and the market and what's going on in the bond business. So as always, folks, let's make some money together.